All right, let's dive into the world of options trading. For a lot of people, it feels like this chaotic, high-stakes game of chance. But what if it didn't have to be? What if you could flip the script and go from being a gambler to a real strategist? Well, that's exactly what we're going to break down.
Does this look familiar? I mean, that feeling, that dizzying sense of just hitting the buy button and hoping for the best? For so many people starting out, options trading really does feel less like a calculated investment and more like a trip to the casino, just a total coin flip.
And let's be really clear here. The stakes are incredibly high. Approaching options with that lottery ticket mindset is, well, it's a direct path to blowing up your account. The source material calls it a perfect recipe for a P&L disaster, your profit and loss, right? So if it's so risky, why is it so darn tempting?
And that question, it brings us right to the psychological trap of options. It's almost perfectly designed to feel addictive. To really get why, we have to take a quick look at how our own brains are wired. See, we've basically got two competing systems running the show inside our heads. On one side, you've got your logical, reflective brain. That's your inner analyst, the one with the spreadsheets. But on the other side, you've got the emotional, reflexive brain. And when you see a super cheap option that has the potential for a massive payout, it's that reflexive side that lights up. And it often just completely overrides the logical part of you that knows the odds are really, really slim.
And here's the absolute core of that addiction. The science shows us that the anticipation of a big win can actually release more pleasure chemicals in your brain than the win itself. This creates this really dangerous feedback loop. Traders start chasing the feeling, that rush of hope, not just the profits. That's the gambler's mindset, but we are here to become strategists.
So how do we actually break that cycle? It's simple, but it's not easy. We replace hope with a plan. This is the big shift. We stop just blindly buying options and we start building defined strategies. And the first one we'll look at is for when you're feeling good about the market.
Now, that might sound completely overwhelming. I mean, there are over 475 known option strategies out there, probably way more that are proprietary. But listen, here's the good news. You do not need to know all of them. You really only need a handful to be super effective.
The foundation for almost all of these strategies is something called the spread. And all a spread means is that you're doing two or more options trades at the same time, usually buying one and selling another. The whole point is to define your risk before you even enter the trade. You're basically making a trade-off. You agree to cap your potential profit in exchange for strictly limiting your potential loss.
Okay, let's build our first one. Let's imagine you're feeling pretty positive about the market. You're not thinking it's going to the moon tomorrow, but you think it's got some room to run up. This is what we'd call a moderately bullish outlook, and it's the perfect setup for a bull call spread.
The setup is actually surprisingly simple. First, you buy a call option with a strike price that's right around where the stock is trading right now. That's called at the money. Then, at the very same time, you sell another call option with a higher strike price, one that's out of the money. And here's the beautiful result. That second trade, the one where you sold the call, it brings in cash. And that cash immediately reduces the cost of the first call you bought. If you look at this payoff graph, you can see exactly what happens. Your maximum loss is now fixed, and your maximum profit is also fixed. You've literally created a defined range of outcomes. No more wild swings, no more just hoping for the best.
Of course, strategy isn't just for sunny days. What do you do when you have a moderately negative outlook on the market? Well, there's a tool for that too. You know the saying, for every bull, there's a bear. And in options, for pretty much every bullish strategy, there's a bearish mirror image. It's all about picking the right tool for the job based on your specific view of the market.
So if you're expecting a modest downturn, you can use what's called a bear-put spread. And the logic here is the exact mirror image of the bull call spread we just built, just flipped upside down for a market you think is heading south. So this time, we're using puts instead of calls. You buy one put option and you sell another put with a lower strike price. And again, the cash you get from selling that second put helps pay for the first one. The result is exactly the same in principle. Your risk is defined if the market unexpectedly rallies against you, and your profit is capped if it falls just like you predicted. Okay, so now that we have our basic bull and bear tools, let's get a little weird. Let's peek behind the curtain at a more advanced and, a somewhat controversial theory about how the options market might really work under the surface.
It all boils down to this one fascinating question. With all of the billions of dollars on the line on an options expiration day, is there a specific price, a specific number, where the market is most likely to land?
Well, the max pain theory says yes, there is. But here's the twist. It's not pain for everybody. The theory basically says the market tends to get pushed towards a price that causes the maximum amount of financial pain for the people who bought options, which means it causes the minimum amount of pain for the big institutions who sold all those options.
Take a look at this chart. Each one of those bars represents a different strike price. The height of the bar shows you how much money the option sellers, the big guys, would have to pay out if the stock expired at exactly that price.
So, the theory suggests that the market has a funny way of gravitating towards the lowest bar on that chart. That's the max pain price. It's the point where the greatest number of options contracts expire completely worthless. This causes the most buyers to lose their money while the sellers get to keep all the cash they collected. It's a pretty wild idea that suggests there are some really powerful forces at play.
Okay, let's bring it all back home. We've gone on a really quick, but I think a pretty powerful journey here, from the emotional roller coaster of gambling to the calm clarity of having an actual plan. You seriously have a new toolkit right now. You understand the psychological trap that pulls you into gambling. You know the power of using a strategy to define your risk. And you have a simple, concrete plan for both a bullish view and a bearish view.
And that, right there, is the fundamental difference. A gambler buys an option and just hopes to get lucky. A strategist builds a position with a clear plan, knowing their exact risk and their potential reward before they even click the button. It's a total shift from raw emotion to clear-headed logic.
So, the real question isn't just about understanding the market, it's about understanding yourself. You have the foundational tools now. The only choice left is which path you're going to take. Are you going to roll the dice, or are you going to build a strategy? The choice is yours.